In this third section of the mentorship, we're going to be talking about top-down analysis. We've got long-term perspective, intermediate-term perspective, short-term perspective with a New York session bread and butter model, and then eventually putting it all together. So let's go to long-term perspective. Long-term perspective, guys. Here we have a nice little quote from the Inner Circle Trader, or ICT. Without the understanding of higher time frame charts, you are gambling, which is very true. So the long-term perspective is the why in why price moves, right? So the long-term perspective, monthly, weekly, daily charts gives us the why. Why should price go up to a specific level and why should price go down to a specific level? We answer the question to why price should move from these time frames, right? All price is doing is trading from one higher time frame premium or discount level to another higher time frame premium or discount level. So what do we need to trade with these time frames, right? We have seasonal tendencies, which is not always necessary, but highly effective when used in combination with higher time frame PD arrays. We need a dealing range and those higher time frame PD arrays. We need higher time frame external and internal range liquidity. We can couple it up with daily SMT and stop hunts, and eventually we'll go into a buy or a sell program. So how do we determine if the higher time frame order flow is on our side? So we can go over a few things. Is price rejecting when going below lows and significantly trading through highs, or is price rejecting when going above highs and significantly breaking lows, right? And think about high resistance liquidity and low resistance liquidity, right? We can spot those with those rejections and easy price movements through engineered liquidity highs, right? Are down close candles supporting price higher or are up close candles supporting price higher? Think about those order blocks, right? Buy side of the curve and sell side of the curve. Are bullish PD arrays failing or are bearish PD arrays failing? With using this, we can also confirm our bias. Seasonal tendencies. Seasonal tendencies are treasure maps to finding low resistance, higher time frame moves when they are aligned with higher time frame PD arrays. So on their own, they don't really mean much, but if you combine it and align it with higher time frame PD arrays, they are very effective. When the seasonal tendencies do align with the higher time frame premium and discount arrays, price is very likely to have a fast and volatile low resistance price swings between one higher time frame price level to another higher time frame price level. When the seasonal tendency don't align with the higher time frame premium and discount arrays, price is more likely to take longer to move from one higher time frame price level to another higher time frame price level. The seasonal tendencies are the 12-month macro laid out in front of you, and we'll show you a chart later how that looks like before the trading year even begins, every single year. So we have those median lines, right? 15 years, 30 years lines, what the seasonal might be doing. Our objective with seasonal tendencies is to blend time, the seasonal tendency, right, and price together, the higher time frame premium or discount arrays. So price meets time and time meets price. So over here we've got a seasonal tendency chart for the US dollar index, and let's focus on January and February, right? Over here we can see they're pretty bullish, right? So we have those lines going up. We have the 33-year line, we've got the 15-year line, and then January and February looking pretty bullish, right? So here we have a US dollar index chart on the monthly. We've got this monthly fair value gap being hit, right? Discount monthly fair value gap, and let's look at how that forms. So we just talked about that seasonal tendency, right, from January and February. Both should be bullish, or at least start to turn bullish in January and February. And when a higher time frame aligns with that seasonal tendency, you can clearly see how that price action explodes to the upside, right? So over here, we still had a bullish seasonal tendency, but you can see price action is just consolidating, right? And we didn't hit that higher time frame PD array yet, which is that discount monthly fair value gap, right? Now, as soon as February starts, we hit that monthly bullish fair value gap, and you can see just in a couple of days, we move way more than we did in the half of this January price action, right? So over here, these three candles keep pushing up, right? And then this whole area, which took a lot of days, 2 weeks almost, and then in a few days we make the same move. So as shown in the previous slide, we can see that even though January has a bullish seasonal tendency, we don't just long because we have a bullish seasonal tendency, right? We need to wait for time to hit price, and price is that higher time frame PDRA, and it needs to align before we get that explosive one-sided price action move to the upside, and that is what we see in February. So back to the dollar chart, right? We've got that bullish tendency. Again, January we did not tap into that higher time frame discount array, but in February we did, right? Breaking structure over here in January, in this move up during February. Displacing up higher, leaving a bullish fair value gap. So we've got a PD array formed where we can take a trade from or base our trade idea from. So we've got a Australian dollar, US dollar monthly chart, right? And let's think about external to internal range again. Keep repeating that, right, for yourself. If you see external range liquidity being taken on a higher time frame, it's highly likely to draw into a higher time frame internal range liquidity, which should be a fair value gap. So pulling up the seasonals, right, we have a bullish seasonal for January and February on the DXY, which means all foreign currencies should go lower, right? So we should have a bearish seasonal in January and February for the Australian dollar because the US dollar has a bullish tendency. Now, after raiding that external range liquidity on the monthly, taking out those buy stops, right? Once we take out that external range liquidity and we are in line with that bearish seasonal, we can see how price explodes to the downside. We have that daily stop hunt, right? And from this point out, up close candles should support price action lower, right? And we can see that over here, price moves up, respecting this area over here, this fair value gap, trading lower and lower and lower until we reach that monthly internal range liquidity. So seasonals, couple it up with a higher time frame PD array. An old high is also a PD array, right? It's a premium area. So we stop hunt over here and then we displace with that seasonal tendency. So again, a reminder, the US dollar index is bullish, right? Bullish seasonal tendencies. We've got that daily fair value gap. So again, back to that Australian dollar, US dollar chart, right? That monthly range buy stops have been liquidated, and now let's look what our dealing range is, right? We've got this range high down into this range low, and then we have a break of structure down here. Equilibrium is around here, so everything above this equilibrium line is in premium. And then if we look at this like this on a daily time frame, we've got that stop hunt up here, break of structure, draw out that premium levels, right? Another daily stop hunt. And if you remember about the silver bullet lesson, right? Intermediate term high has been formed over here, right? So even on the daily time frame, you can spot that silver bullet setup. After we go into bearish order flow, right? After respecting bearish arrays, we should see all up close candles supporting price to go lower. And we can see that over here. Price trades back into that bearish order block. Those up close candles trades lower, forming another bearish order block. Over here, tapping it in slightly, moving down lower. We have another bearish order block, and we keep declining until we hit our target, right? So we go from external back to internal on the higher time frame. So over here we've got a British pound US dollar monthly chart, right? We've got that premium levels outlined over here, right? This little red box, and then the discount levels down here all the way to the low, which should be discount, right? Now, what did we do over here? Monthly premium. Can we spot something else? We've got that mitigation block, right? This should have been a bullish order block which got violated. And now we're using that on the sell side of the curve to look for a monthly premium level. Now we rate those buy stops over here on the monthly and then declining lower. So with that bearish seasonal, right, and a bullish seasonal for the DXY, remember? So if DXY has a bullish seasonal, then all foreign currencies should trade lower, which would be a bearish seasonal for the British pound, US dollar. Now we don't just look for shorts in January because we have a bearish seasonal tendency, right? We need to wait for time to meet price and to meet on the DXY as well, right? So higher time frame PD array on the DXY. Remember in January that fair value gap got hit, and that should be the catalyst to trade down lower. Now, if you're unfamiliar with SMT, it is when, let's say, these highs are not getting rated, right? And on DXY, the lows are getting rated and then continues to move up. This is considered SMT. So over here we got daily SMT with the Euro USD. So over here we are not taking out any highs on GBP USD, and on Euro USD we are presumably taking out those highs, right? Because DXY pushed down into the lows, which makes Euro USD most of the time be in line and take out the highs. So we have some SMT going on over here, and now it is lining up with that bearish seasonal tendency, right? So we don't need to liquidate this high for this to decline lower in February. Zooming in a little bit more, right? We've got those daily external sell stops down here. We've got internal range liquidity down here. Again, after that SMT has occurred, we don't need to go above these highs anymore or this high. So we're waiting for a bearish array to form, which is this fair value gap, right? And it is in premium. That's also important. Now, what are we forming over here? Think about that silver bullet lesson, right? This is an intermediate term high, making it even more probable that we're going to continue lower and lower to eventually take out this sell side liquidity. So from internal range liquidity, what are we looking for next? External range liquidity, right? So from internal to external. Got some more external range liquidity down here, right? Before we go to the extreme target, which is this low down here. So after drawing out that premium and discount level, right, we can see those external range liquidity sell stop has been taken after we formed that intermediate term high. Now we can anticipate a short-term high forming next to this intermediate term high, right? Because this intermediate term high is a intermediate term high because we have a short-term high to the left of it and now a short-term high to the right of it. We're hitting that bearish fair value gap, right? So we have a premium array. If we take this high, this range high to this range low, right? Price trades back into it, comes back one more time over here and continuing that bearish seasonal tendency, hitting a higher time frame POI and then eventually taking out that sell side liquidity. So over here we've got a Nasdaq 100 E-mini futures chart, monthly chart. Now without knowing the seasonal tendencies, we can still look and see where the higher time frame is most likely to move. Because remember, price is just moving from one higher time frame level to another higher time frame level. So outline the dealing range, right? First of all, this range low to this range high. So we've got our dealing range. We're going to look for daily SMT or stop-ons, and then we can see where we go from internal to external and external to internal, right? So what do we see over here? We've got a monthly fair value gap, right? Internal range liquidity. So where do we want to go next? What do we do after we take internal range? We go to external range, right? So we've got that monthly external range liquidity up here. So we know we go from internal to external and a draw on liquidity without knowing those seasonal tendencies, right? We know where price is most likely to draw into. Now let's look at the weekly structure after knowing what the monthly is most likely to do, right? We've got that monthly discount fair value gap, internal range liquidity, remember? We're going to external range liquidity next, so we know the weekly should be bullish, and without knowing those seasonal tendencies, we can use all the PD arrays moving up into that external range until we liquidate that. So over here, we drop down right into that discount fair value gap on the monthly. Now we have weekly external liquidity, which is over here. So where do we go after we take that weekly external? Your eye should immediately go to internal range liquidity, right? So you look for a fair value gap, which is down here, right? Again, draw out your dealing range, this low till this high. Then we've got that internal range liquidity. Then we can continue up higher. So from internal to external, from external to internal. And once we hit internal, we want to go external once again, right? So we take out this high over here, right? External range liquidity, internal to external. And where do we want to go next? To the buy stops. Right, so over here we've got another example. We've got the Euro Australian dollar daily chart. Now, without knowing seasonal tendencies and using a daily structure, because the monthly and the weekly is unclear, right? We can still go to a daily structure and see where we can find our setup and our daily draw on liquidity. So over here, first of all, external range has been taken. I give you a few moments to see where you are most likely to draw into, right? So where do we go from external? Right, we want to go to internal range liquidity, which is this fair value gap. So draw on liquidity even without knowing the monthly or the weekly, because that's unclear and we don't know what the seasonal tendency is, we can still see internal range to external and external range to internal range can be utilized to still figure out where the daily time frame is most likely to trade into. Higher up in the range, same occasion, right? We have this dealing range low into this dealing range high. What is happening over here? We're creating an imbalance, right? In discount, that's important. We don't want to see that imbalance in a premium level. Taking out this lows down here, creating a intermediate term low, and then continuing up from that discount fair value gap. So using structure on daily, we can still know where we want to go. We went external, right? And then we go back to internal. And once we hit internal, we want to go external once again, which is up here, right? Putting that I on there. So over here, external buy stops, and this keeps repeating over and over and over again. So external has been taken. So now where do we want to draw into, right? Again, we go from external to internal and then from internal back to external. So internal range liquidity, this fair value gap, and might I just add, we don't know what the weekly is doing, right, and the monthly, and we don't know what the seasonal tendency is, and we can still determine our draw on liquidity this way. Discount fair value gap has been hit. Now where do we go? External once again, right? So from down here all the way to up here, it is all it is doing. It's going from external to internal, back to internal, back to external, right?